Okay, welcome back to Chapter 21, Part B. So, I'm just going to review how to do the changes, although again using 315, so hopefully it's coming back to you. So there's three suggested methods: retrospectively, currently, and prospectively. So retrospective, it's retroactive application. So what you have to do is calculate the cumulative effect of the change on the financial statements at the beginning of the period as if the new method or estimate had always been used. An adjustment is made to the financial statement through retained earnings, because we're looking back, equal to this cumulative effect. In addition, all affected prior year's financial statements must be restated on a basis consistent with the newly adopted policy, as if the new accounting policy had always been used. Okay? So, they decided with IFRS we have to change to a new way of financial assets. Usually when they make a change in policy, like a change to IFRS or ASPE, they will tell you how they want you to do it, and usually it's retrospective. Now, if you've been operating your business for 35 years, you likely won't go back 35 years to restate. Okay? What happens in industry, definitely at the minimum 5 go back, but I've seen 10, I've seen 5, and I've seen kind of between. So that will depend. We're going to use this method for a voluntary change in accounting policy and correction of an error. Also, involuntary change in policy if they don't tell you the transition. So sometimes the transition method will be prospective, not retrospective. But if it just says, oh, now you all have to change and do this, retrospective. Okay, so voluntary change in accounting policy, correction of an error, and involuntary change. The transition method is not stated. Current, that is certainly an option. It has not been used in accounting for a long time, and most jurisdictions don't. Now, what you guys do in the future with accounting, that could change, but right now we don't do it. Prospective, previously reported results stay the same, so they're the same. No changes made in prior periods. So don't adjust opening balance, and you don't try and fix the past periods. All you do is adopt for current and future periods only and apply to balances existing at the date of the change. So use this for a change in accounting estimate or if a policy is needed for the time. So this is the only times you use it. A change in accounting estimate or if a policy was needed for the first time. So on page 4, there's a little summary that you can keep handy, and it should help you through doing this section. Okay, so what I want you to do now is pause the machine, oh my gosh, pause the video, and I want you, well, after I finish this. So example 1, you're going to consider these independent scenarios for a company operating under IFRS, and I want to know if it's a change in principle, a change in estimate, or an error, and what accounting treatment each would. Okay? One of them is tricky, and, well, I might as well tell you it's the last one. So it's a little bit tricky, but otherwise, pause the video and spend 5 minutes reading through these, trying to see if or how, sorry. Pause the video. This is just like I'm in class. Pause the video and figure out if it's a change in principal, estimate, or error, and whether you do retrospective or prospective. I'm just going to keep going, assuming you paused it and done your work. Now, one thing I failed to mention up here, our little chart, tax effects must be considered in each scenario. I just want to write a little note here. Mostly an adjustment to FIT or DIT, whichever you're using, a few errors, for example, inventory methods, will affect CIT payable as well. So you just have to watch out for that. Okay, so you're all back. Paused it. We're going to go through these questions. So, the Vice President of Sales had indicated that one product line has phased out over the next 3 years. Therefore, we're going to lower the estimated lives on related production equipment from the remaining 5 years to 3 years, because we're going to stop using them after 3 years. So hopefully you got that one. It was a change in estimate, and you would adjust it prospectively. And that's because there's new information. They weren't wrong when they said there were 5 years left. It changed. Now, the High-Tone building was converted from a sales office to offices for the accounting department at the beginning of the year. Therefore, the expense related to this building will now appear as an administrative expense rather than a selling expense. Okay, classifying expenses as selling or admin, does that have anything to do with accounting policies? No. So this is totally just a change in classification. And no need to do anything. Just do it. Now, estimating the lives of new products in the leisure products division has become very difficult because of the highly competitive conditions. Therefore, the practice of amortizing pre-production costs has been abandoned in favor of such costs as they are incurred. Okay, so they're finding out, ooh, you know what, maybe this product isn't going to do so well. We can't capitalize and spread the costs over the next few years because there may not be a few years left with this product line. So, has something underlying changed? Yes. So, even though a policy has changed, because it is due to underlying conditions, changing, it's going to be a change in estimate. So that means it's prospective. So that's an example where, yes, we're changing the policy. Before we were capitalizing, now we're expensing. Notice this is just moving one expense to another, not capitalizing versus expensing, okay? It's a big difference between those. So this, instead of capitalizing and expensing, we're not anymore. We're going to expense. So we did change the policy, but then we go, well, did we have to? Should we adjust retrospectively, or did it come from new conditions? Well, it came from new conditions. So that means it's a change in estimate. We don't have to go back and adjust. Now, management has decided to switch from FIFO to average cost for inventories. Now, the only reason they can get away with that is there has to be more relevant information. Okay, so we assume that. Or they couldn't do it. So, definitely it's a change in policy. Did it say anything? Now with these questions you have to watch for stuff. Did it say anything about, oh, new information came out and the industry decided to change to this method, so we decided to follow? If it did, then it would be a change in estimate. But it doesn't, it just says, oh, they changed it. They must have done it because of more relevant information. So it's in policy and it's going to be retro. And it was voluntary, just so you know. Some of these are a little bit hard to get your head around, right? Because now we've gone past bookkeeping. We've gone so far past it. This is definitely stuff that requires more judgment, you understanding all the differences. So don't get stressed. Just go through it, look at it, reason it through again, and email me if you've got questions. Okay, number 5. When the year-end physical inventory adjustment was made for the current, the controller discovered that the prior year's physical inventory sheets for an entire warehouse were mislaid and excluded from last year's count, which happens. It definitely happens. It happens more than once. Okay, so is this a change in policy, a change in estimate, or an error? Well, it's obviously an error, so it's going to be retrospective. Now, here's the tricky one. The company's custom division manufactures large-scale custom design machinery on a contract basis. Management decided to switch from the completed contract method to the percentage of completion method for accounting for long-term contracts. So I said this one is tricky because you had to remember way back to 315 and ask yourself, are these interchangeable? So are these interchangeable? When we did number 4 on the last page, FIFO or weighted average, those are interchangeable. You can use whichever one suits. These two are not interchangeable. Usually the reason you use a completed contract method is when there's uncertainty in the receivable. Okay? And not only uncertainty, if you can't estimate the costs and revenue streams, all kinds of things from that whole chapter on construction contracts. But that's a big one. Once you've got your receivables under control and your estimations under control, so let's add estimates. Then you can use percentage of completion. Okay? So, yes, it's a change in policy, but not a retrospective adjustment needed, because something must have changed underneath. Okay? So some underlying condition must have changed. Because a company can't suddenly switch from completed contract to percentage of completion. Okay? So if an underlying conditions have changed, then it's going to be change in estimate. And it's going to be prospective. So I hope those made they're a little bit crazy to think of them, because all of a sudden you're looking at everything you've learned in financial accounting, all the different policies, all the different ways you can make errors, reasons for why you could change, and so it can get a little bit hairy. But work through as many questions as you can and email me if these 6 things didn't make sense. Okay, that's the end of part B for chapter 21. Bye.